In this video, I'm going to break down the 7 types of mortgages we use to buy our investment properties. You might think all mortgages are created equal, but that's a big mistake. Stay tuned to discover which mortgage types can help you maximize your investment returns. Choosing the right type of mortgage for your investment properties can significantly impact your financing costs, cash flow, and overall investment success. The wrong mortgage can lead to higher interest rates, increased monthly payments, and potential financial strain. Here's why you need to hear this. Understanding the different mortgage options and how they align with your investment strategy is crucial for making informed decisions and maximizing your profits. Fixed-rate mortgages are one of the most common types of mortgages used for investment properties. These loans have a fixed interest rate that remains constant throughout the life of the loan, providing predictable monthly payments and stability. Fixed-rate mortgages are ideal for long-term investments, where you want to lock in a low interest rate and avoid the uncertainty of fluctuating rates. They are particularly beneficial in a low interest rate environment, allowing you to secure favorable terms for the duration of the loan. When considering a fixed-rate mortgage, it's important to compare interest rates and terms from different lenders to ensure you're getting the best deal. Keep in mind that fixed-rate mortgages typically require a higher down payment and stricter qualification criteria compared to other loan types. Adjustable-rate mortgages, or ARMs, have an interest rate that can change periodically based on market conditions. These loans typically start with a lower interest rate compared to fixed-rate mortgages, but the rate can adjust after an initial fixed period. ARMs can be a good option for investors who plan to sell or refinance the property before the adjustable period begins. The initial lower interest rate can result in lower monthly payments and increased cash flow in the short term. However, ARMs come with the risk of rising interest rates, which can lead to higher monthly payments in the future. It's important to carefully consider your investment timeline and risk tolerance before choosing an ARM. Interest-only mortgages allow you to pay only the interest on the loan for a specified period, typically 5 to 10 years. After the interest-only period, the loan converts to a traditional mortgage, and you start paying both principal and interest. These loans can be beneficial for investors looking to maximize cash flow in the early years of the investment. The lower initial payments can free up funds for other investments or property improvements. However, it's important to be prepared for the increase in monthly payments once the interest-only period ends. This type of mortgage can also be riskier if property values decline or if you're unable to refinance or sell the property before the higher payments begin. FHA loans, insured by the Federal Housing Administration, are available for investment properties under certain conditions, such as purchasing multifamily properties where you live in one of the units. These loans offer lower down payment requirements and more lenient credit criteria. FHA loans can be a good option for new investors or those with limited funds for a down payment. The ability to finance up to 96.5% of the property's value can make it easier to enter the real estate market and start building your portfolio. However, FHA loans come with mortgage insurance premiums, which can add to the overall cost of the loan. It's important to weigh these costs against the benefits and ensure the property meets the eligibility requirements for an FHA loan. VA loans, guaranteed by the Department of Veterans Affairs, are available to eligible veterans, active duty service members, and certain members of the National Guard and Reserves. These loans offer several advantages, including no down payment requirements and competitive interest rates. For eligible investors, VA loans can be an excellent option for purchasing multifamily properties, as long as you live in one of the units. The ability to finance up to 100% of the property's value can make it easier to enter the real estate market and start building your portfolio. However, VA loans have specific eligibility requirements and may not be available for all types of investment properties. It's important to understand these requirements and determine if you qualify for this financing option. Portfolio loans are loans that are held by the lender rather than being sold on the secondary market. These loans are often used for investment properties that don't meet the standard criteria for conventional loans, such as properties that need significant repairs or have unique characteristics. Portfolio loans offer more flexibility in terms of loan terms and qualification criteria. They can be a good option for investors with multiple properties or those who need customized financing solutions. However, portfolio loans often come with higher interest rates and fees compared to traditional loans. It's important to carefully compare the costs and benefits and work with a lender who understands your specific investment needs. Commercial loans are designed for properties with 5 or more units or for mixed-use properties that combine residential and commercial spaces. These loans are typically offered by commercial banks and have different qualification criteria and terms compared to residential loans. Commercial loans can provide higher loan amounts and more flexible terms for large-scale investment projects. They can be a good option for investors looking to expand their portfolios with multifamily or mixed-use properties. However, commercial loans often require a larger down payment and have higher interest rates compared to residential loans. It's important to work with a lender who specializes in commercial real estate and can provide the financing solutions that best meet your needs. To recap, understanding the different types of mortgages available for investment properties and how they align with your investment goals is crucial for making informed decisions and maximizing your returns. Whether you choose a fixed-rate mortgage, ARM, interest-only mortgage, FHA loan, VA loan, portfolio loan, or commercial loan, each option has its own advantages and considerations.